Welcome to this Asia Global Institute webinar on the economic challenges of the coronavirus crisis. We are coming to you from the Asia Global Institute at the University of Hong Kong. My name is Alejandro Reyes. I'm Director of Knowledge Dissemination at the Institute. Our guest today is Zhiwu Chen, Director of the Institute, Chair Professor of Finance, and Victor and William Fung Professor in Economics at HKU. We are practicing appropriate social distance and hope that you are too, wherever you are. If you have any questions during the course of this 45-minute session, please send them by email to agimail@hku.hk. There really is no need for me to set the scene for this discussion. So I'm just going to dive right in and talk to Professor Chen. So Professor Chen, you are not only an economist and an expert in financial markets, but I know you are a student of history. Let's focus on understanding the scale of the negative impact on the economy and the financial markets of this crisis. Most recently, we had the 2008-9 global recession. And in terms of pandemics, we had the Spanish flu of 1918 and pandemics in 1957, and again a few years later. We had SARS in 2003, though SARS did not go global in the way that the coronavirus had. So while it's hard to make predictions, where do you see us right now and where we might be going? Because the news seems to be bad every day, even every hour at times.
Yeah, thank you, Al. So, first I have to say, as we all know, the crisis is still going on. In fact, if you watch CNN or any other news channel, all the time, every minute, everyone is talking about the virus and the impact in the US, in Italy, in the UK, and so on. So with that said, we do have some early indications of what the pending economic implications will likely be. So first, on the economic side, as we all know, the virus first started in China. So there is some data out based on the data for the first 2 months of this year, January and February. The Chinese economy is down by about 15% for the first 2 months, based on economic, manufacturing output and the service sectors. So more specifically, for the first 2 months of this year, China's industrial sectors, value added, is down about 13.5%, and the service sectors output down by 13%. So the general consensus is that for GDP this first quarter for China is expected to be down by about 15%. And then for the whole year this year, most economists following China expect the GDP growth rate is likely to be around 1%. Of course, that will be like the lowest GDP growth rate if there's any growth at all over the last 40 years. So that just shows the magnitude of the economic impact. But of course, for Europe, for the US, even for Hong Kong, it's still too early to tell what the magnitude of the economic impact will be. But the stock markets, if you think that stock markets are indicators and estimates of what will come down the road, then the U.S. stock market is down about 35%, and then for Hong Kong, down 22%, and for the UK also down about 32%. Of course, as some of you may have read, the Shanghai Composite Stock Index is down the lowest down less than 10%, which has made many people say that, wow, the Chinese Asian market seems to be the safe harbor at times of crisis like this. But of course, with the caveat, we all know that the Chinese government has been doing a lot to try to keep the indices higher. So the economic and financial implications are very severe. So this is why from Trump to Boris Johnson and many others, they have been very busy trying to introduce stimulus efforts, try to stop the economic downturn from really going into a full recession or even a great repression. But I think we should all keep in mind that when we're in the middle of it, we should not panic too much. Personally, I think the experience we have had in Hong Kong should be a good reference. I mean, for most of us who have been in Hong Kong, we know, yes, there has been a lot of inconvenience, but it's not that bad. And restaurants have been open, and offices have been in operation for the most part. Of course, social gatherings and social distancing have been more in place. So there are a lot of inconveniences. But I think the overall economic impact, while clearly significantly negative, it's not the end of the world. So we should all keep this in mind, especially when we have to decide how to invest our money. Then we should not really panic too much, because at the end of the day, we still have many years to go to live our lives. We still have to have 3 meals a day and 365 days to live, and New Year's and many other things will all come back to us in a normal way. So with all of that in mind, we should treat this largely as a short-term setback.
Thank you, Zhiwu. I'm wondering if we could talk a bit more about China, and particularly, before the coronavirus, we already had the economy appearing to slow down. You had the U.S.-China trade friction, and now you have the coronavirus. China now appears to have the infections under control, at least the community infections, and people seem to be going back to work. Do you see more lasting impact as a result of what's happened? What kind of recovery could we see? Will it be, they talk about the V-shaped or the L-shaped curve. What are your thoughts on where China might be, say, in a year or longer?
Yeah, I think first of all, the general context just prior to the coronavirus crisis was like this. The Chinese economy, from the trade war and also from the more or less natural slowdown after 40 years of economic growth, was already happening. And then in contrast, the US economy was in very good shape, with unemployment rates at 3.5%, and the factory and other industrial outputs and services all doing well in the US. So that's the sort of contrasting pre-crisis comparison between the US and China. But now with the crisis hitting, it seems like today, of course, China is recovering. It's especially if you look at the percentage of businesses that are either back to production or back to services. So right now it's about 73 to 75%. So about 3/4 of the businesses are back to production mode or service mode, even though the whole capacity has not been totally recovered. On the other hand, in the US, everyone is panicking as if the world will come into an end. But in any case, let me focus a little bit more on China because we have relatively more time because China has been in this crisis for about 2 months, and now businesses are going back to normal production, and different communities and people are going back to work and going back, the classes in schools are also starting. So now the question, as you said, as you asked, what is the long-term impact? Even though the short-term impact may be not too bad, because people are gradually going back to work, going back to school. What about the long-term impact? So this is why I'm much more worried about the long-term impact, because based on the data available so far, if I have to contrast the state-owned enterprises with the private businesses in China, how the two groups have been doing relative with each other as a result of this crisis. Based on the first 2 months of official data, the SOEs suffered about 7% loss relative to the same time last year in terms of value added or value creation. But for private businesses, they have together suffered about 21%. So 3 times as much decline in value creation by the private firms when compared to the state-owned enterprises. So what that means is, as a result of this coronavirus, very soon we're going to see that the Chinese economy will be much more dominated by state-owned enterprises than before. Okay, so private firms will move away. Many of them will be shut down. So private employment will also go down. Just to remind you, up to this point, more than 85% of employment growth in China has been coming from the private sector, not from the state sector. So as the private sector goes down more in relative importance as a result of this virus crisis, the Chinese economy will shift further back to the pre-reform state or structure of things. As we know, the state sector does not produce much return for the assets, for the resources they use. So what this means is economic efficiency will suffer for the Chinese economy in the longer term. And the private sector will shrink more, and the state sector will increase more. So this is an implication that's totally the opposite of what the early reformers really intended to do.
Thank you. So what should outsiders, particularly investors, people investing in China or companies investing in China, what would that mean for them if they're thinking about that more long-term impact?
Many friends in China have been asking me or have been making the comment that when you compare the relative performance by the Asia market in China and the U.S. stock market, the U.S. market is down about 35%, and the Chinese Asia market is down by almost by less than 10%. So they say that now people should invest more in the Asia market rather than in the U.S. market. But I think one has to be really careful because the Shanghai Composite Index consists of 300 listed companies, and those companies' stock prices have been the main target of government organized efforts to buy shares to push up the share prices. So to make a long story short, we are kind of facing a situation where the Asia market should have been down maybe 20% or more, but instead it has been only down by 10% or 9%. On the other hand, the US stock market maybe should have been down by 15 or 20%. Instead, because of the panic, it's actually down by 35%. So as a value investor, which market is more attractive to you? Should you invest in the US market because it's down by much more than justified? Or should you invest in the Asia market where the decline so far is much, much less than what it should be? For value investors, the choice is obvious. You want to go invest in a market where there's too much excessive decline due to the panic behavior and avoid stocks whose prices are artificially inflated through government interventions. So here is actually a good time to remember some of the teachings or advice by Warren Buffett. I really like one of his pieces of advice, that is, be fearful when others are greedy, and be greedy when others are fearful. So what this means is that as an investor, you don't want to buy when everyone is very optimistic and very greedy, buying or what. You should stay away. You should be fearful. But on the other hand, when everyone else is panicking, is very fearful, and dumps whatever they have in their portfolio, that's when you want to be greedy. You want to buy, right? So I know I should not give any stock advice here, but what I'm trying to say is the stock market in the US may not be at the bottom yet. It may still have some downside to go. But at least compared to 35% ago, we are now much closer to the bottom. So if you're a long-term investor, then you might think about what Warren Buffett has been saying for many years. Be greedy when others are fearful. As someone who has studied stock markets for many decades, I can say that normally when everything is normal, everything is smooth, it's very tough to make 20% or 30% a year. But when we're in a situation where people are just so panicky, and as if there's no future anymore, that's when good investment opportunities really exist. If you know how to make the right selections of good investment, good companies versus bad companies.
Thank you. Can we focus on the US? Because part of the panic in the market is related to what is the US government doing? And of course, the debate in recent days is about the economic rescue package, if you will, that is being discussed in Congress. There have been, I think, $1.8 trillion or $2 trillion is being bandied about as a figure. What are your thoughts on what needs to be done in the US?
Yeah, this is actually a very interesting debate that is still going on. This is like the first time when I see that the Federal Reserve and the US Congress, Senate, and the White House are all trying to add more intervention packages. We started with the Federal Reserve first cutting interest rates by 0.5%, and then 10 days later, cut interest rates by 1%, and then added quantitative easing. Even last night, the Federal Reserve said, "Oh, we're going to buy unlimited amount of corporate bonds and mortgage-backed securities and other instruments just to provide liquidity to the market." And then at the same time, the House, the Senate, and the White House are all negotiating day and night to talk, to reach an agreement to introduce either a $2.5 trillion stimulus package or some people say it will take $4 trillion or $5 trillion. But I think we should all step back a little bit because for economics, right, for the real economy to be affected by the Federal Reserve monetary policy actions and by these economic stimulus packages, the actual economy needs time. Okay, so we should not just think in a following way. That is, okay, 2 days ago we introduced a big package, a big intervention effort, and then today, 2 days later, we still don't see much impact from the intervention introduced 2 days ago. And then we should act again to add more interventions. At times like this, we should realize, yeah, it's not surprising, right? Because we introduced the first intervention just 2 days ago. The actual economy, the restaurants, the manufacturing firms, the service providers and consumers, they're not going to act so quickly because even for corporate decisions to take place, they need to go through processes. Those processes for new investments, new expansion may take weeks or even months to really have any effect, right? Of course, we are actually in the U.S. Right now. Everyone knows, Trump pays attention, almost too much attention to how the stock market is doing. So when the stock market keeps going down, 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 then he gets to be more and more panicky without realizing the stock market is an advanced pricing mechanism of the future expectation. So the stock market can react very quickly, much faster than the real economic processes. So this is why, in some ways, maybe the U.S. stock market, other financial markets should be halted for a few weeks so that the real economic process will have enough time. And then in particular, the virus and the healthcare process will be given enough time to, sort things out and so on, while healthcare people, medical doctors, and economic decision makers spend their time to sort things out, then the financial markets should be halted because the financial markets typically move much, much, much faster than the real economy, and of course, then doctors and healthcare providers. So I think this is one situation where the fast-paced financial process, on the one hand, and then the slow-paced economic process and medical healthcare treatment processes, the two don't match so closely. So this is when perhaps it's a good idea to have a bank holiday or financial market holiday, so that the real world will be given more time to work things out.
Thank you. Can I pursue that further? If you listen to President Trump on his daily briefings, it does seem that he would like to get the economy going again sooner than later. There is a feeling, and I think there is this emerging debate about whether the cure might be worse than the problem itself. How do you see that? Are we risking creating a real depression if we continue the social distancing, all the shutdowns, the lockdowns? And is there a point where we really have to say, well, we need to get the economies going?
Well, definitely every decision maker and policy maker knows that the sooner we can get the economy going again, the better it is for everyone, for every family, every individual. There's no question about that. But I think at this point, the problem is not whether there is capital being supplied to corporations, whether the cost of capital is too high or too low. Rather, all those financial metrics are not as important as the key determinant of whether we can start the economy and start the businesses again. What is the main bottleneck, main holder of further economic resumption is really the virus itself. It's more objective, more external to human behavior. I mean, to economic and social things. So this is why the real world needs more time, and then the financial world can take a break for a little while. Maybe we should also look at one sort of relevant experience from the past. That is the Spanish flu of 1918 to 1920. So during that 2-year period, the Spanish flu killed about 39 million people around the world. So that was a major pandemic of the last 100 years of human history. But even given the size and magnitude of the human impact from the Spanish flu, the global GDP during that period only went down by about 6%. And the stock markets went down by 26%. So, of course, we have not seen the end of this current pandemic yet. The US stock market is down by 39%, 35%, much more than the 26% of stock market decline experienced during the Spanish flu period. And then, of course, many experts say that, well, this time the global GDP may shrink by 30% or 40%. Well, the last big flu that took place 100 years ago only led to a 6% GDP loss for the global economy. I think this is why we should look at some reference points, and then those reference points should give us a more rational assessment of what can be. But of course, I understand Trump would like to get the economy back to 3% growth mode as soon as possible. I mean, so do I. I would really like to, especially the U.S. stock market, to recover as soon as possible because I've suffered a lot of loss from that. So I'm just as impatient as he is. But on the other hand, as an economist, I have to say that we don't want to excessively intervene in the economic and financial processes. In particular, in my recent article with Harvard Theater, published in Asia Global Online, we talked about why monetary policymakers should think twice or thrice when they introduce interventions, because monetary interventions, economic interventions at times like this can definitely exaggerate wealth inequality and income inequality down the road. To make a long story short, historically, we have learned that wealth inequality and income inequality only go down on a sustained, meaningful basis during two types of crisis periods. The first type of crisis period is mass mobilization violence. like big wars and empire collapsing and big revolutions. So that's one type of events that can really make asset prices go down by significant amount so that the rich get hurt and asset wealth will go down. Okay. The other type of events that have reliably shrunken the income inequality and the wealth inequality is epidemics. So like the Black Death, going back to the 14th century, really cut income inequality and wealth inequality in Europe tremendously. Of course, that came at a big human price because, in some towns in Europe, more than half of the people died from the Black Death. So because of that, all asset prices went down, and then that just helped reduce the income inequality and wealth inequality. But now we have modern governments and modern central banks always now standing ready to help to intervene and help stabilize financial asset prices. So when they do intervene to stabilize or even push up financial prices, then you wonder who really benefit much more from the interventions by governments. Of course, those who have financial assets will benefit the most. So if that's the case, monetary interventions, economic interventions, while they may serve a good purpose in the short run to stabilize the economy, but those government intervention efforts also exacerbate or exaggerate the income inequality and wealth inequality. So this is why, especially in China, on many occasions, I've been saying, we should not just always talk about how bad income inequality is and wealth inequality is. And then when we make monetary policy decisions and economic policy decisions, we forget that our decisions on the policy side have exactly important implications for the wealth distribution and income distribution. So what I'm trying to say is that we should be mindful of the income distribution and wealth distribution implications when we make policy decisions. We should not de-link or separate the two. The two are very tightly linked to each other. We should never forget that.
Great, thank you. I'm going to go to questions that we're getting from our viewers. From someone in Vietnam, what are the necessary policies for neighboring countries of China in response to the economic impact of this crisis?
Because I expect more decoupling to occur as a result of this virus crisis. So by more decoupling, I mean, the U.S. and other economies will very likely want to cut their dependence on China, on supplies and manufactured products out of China. So Vietnam and other countries should improve their investment environment so that they can receive more of the value chain movement out of China and to new places. So I know for the last 2 to 3 years, just as the U.S.-China trade war negotiations had been going on, Vietnam already benefited a lot. But I think there's probably more to go as long as Vietnam can improve further the investment environment for foreign capital and improve the infrastructure so that the overall industrial production and export capacity of Vietnam and Thailand, India, and other countries can be increased. Then there will be more opportunities to come as a result of this upcoming decoupling.
In fact, I go to a question from Patrick. Will the COVID-19 crisis accelerate a movement towards deglobalization as countries seek to reduce their dependence on trade partners, particularly China, on the grounds of national economic security? So could China be a major long-term loser from this crisis?
Yeah, I agree with Patrick. The other day when I was watching this interview by CNN with this former Ohio Governor John Kasich. You know, I lived in Ohio for 4 years when I was teaching at Ohio State, so I can relate to this governor. But this governor is a very reasonable, rational governor. I like him a lot. But even he on TV was really questioning very harshly American businesses. Why just in order to cut costs, they would move all the production to China and so on. I think they, of course, I'm a Chinese, so I would like China, the Chinese economy to keep doing well and so on. But I understand from his perspective, he was this former governor was so mad that now China was threatening to cut off the medical supplies and other things to make, to use such supplies as a threat. So Governor Kasich said, American businesses have to rethink about their global distribution of production and cut their dependence on any single country so that American citizens' livelihood would be more robustly supported instead of being overly dependent on one country. So I think, unfortunately, as much as the Asia Global Institute and I personally would like to promote more globalization, it looks like some setback is tough to avoid as a result of this virus crisis.
Thank you. We have a question from a Hong Kong U MBA alumnus or alumna. What is the biggest impact of coronavirus on the banking industry in Hong Kong and China?
I think the banking industry may be more indirectly affected rather than directly. By indirectly, I mean, for example, the if deglobalization would really accelerate, at least to some extent, then that would make the cross-border banking transactions and service demand go down to some extent. And then if deglobalization would affect financial globalization, so overseas cross-border listing opportunities for corporations and bond listings and other financial transactions would all suffer to some extent. But I don't think the banking industry would be directly affected so much.
I would just like to let our producers and viewers know that I'll probably go over the 45 minutes a bit. So because we've got a lot of questions. Can I ask you a question from Ruslan? Financial crisis, which is also driven by a timely sort of perfect storm. You have the OPEC oil issues, the oil went down drastically, the price. Will this low price of oil, if it continues for a long time, do you see that affecting the booming development of renewable energy?
Oh, definitely. It has a very direct impact because all the different energy sources are priced relative to each other. So if the mainstay of human fuels, that is, oil, is so cheap. So that makes solar power and wind power and so on look more expensive. And then consumers will react very quickly. So in that sense, it's a very big negative for renewable energy, as long as oil prices would stay very low. So of course, on the other hand, for the larger economy, oil price going down from $60 a barrel to now $22 a barrel. So that's a big 66% decline. So that's a big economic boost, much bigger, much more significant than this possible $2 to $3 trillion U.S. government stimulus package to the global economy.
All right. I have a question from Nick, who's an IT specialist from New Jersey. Could humans use the global market disruption caused by COVID-19 as an opportunity to restructure significantly the global economy? And do you see sort of, if so, what are some potentially progressive ways that market forces could be shifted, could be adjusted?
Well, deglobalization is already one channel that this virus crisis may lead to a restructuring of the global economy, right? And then, of course, healthcare, the importance of healthcare in the minds of policymakers, in the minds of households, will all go up. So that will make innovations, capital supply, and government funding for health-related inventions, innovations all go higher. So that's another sort of structural shift that will likely take place from as a result of this crisis. And then global geopolitical structures will be affected as well. So that's another dimension in which this virus crisis can affect the world. So in fact, scapegoating will likely follow after things stabilize in the U.S. and other countries.
No, in fact, you wanted to say something about scapegoating, so it is a good time then.
This is actually it's a very interesting human behavioral dimension. As I teach in my course, the economic logic of civilizations, why witch hunting, witch killing was taking place in medieval Europe, and why anti-Jewish sentiment was so high during the Middle Ages, leading to many Jews being persecuted and killed. So now many historians have found the Black Death and a large number of epidemics that occurred in Europe during the Little Ice Age from the early 14th century, lasting all the way to the 17th century. So those pandemics, epidemics, and other bad things that occurred during the Middle Ages were responsible for triggering the desire by many Europeans to look for a scapegoat for the bad experience they had. But I think this time, many Chinese Americans and Chinese living in Europe are already experiencing some discrimination and bad acts against them. So I hope that it's not going to get worse. But if the Middle Ages experience by the Jews and then by women in Europe is any guide, we all have to be very careful and mindful of the irrational behavior related to scapegoating that may occur as a result of this virus crisis.
An important issue. We have about sort of 5 minutes, I think, that we can go on. If I could just ask sort of one investment question and then one maybe geopolitical question. Joy is asking about retirement, people who are facing sort of retirement savings. Do you have any particular recommendations for those folks who have invested a majority of their funds in sort of long terms or treasuries that have recently fallen significantly?
Yeah, I think if your investment was already in place and it's still in place in different stocks, different index ETFs, or different mutual funds, I would not try to get out of them right now, because a lot of damage has already been done. It's a little bit too late to get out. So I would not move the money, the retirement funds, out of their current positions. But at the same time, I would buy a good insurance portfolio, like a healthy insurance, and some especially major illness, major disease insurance, and then some other retirement arrangements linked to life insurance and so on. It should be a good way to go. So in other words, if you're already very close to retirement or already in retirement, then I would put the new investments in the safer fixed income, especially insurance types of products, rather than in stocks, because of the higher risk.
Precious metals?
Precious metals, especially after gold has been beaten up over the last 2 weeks. It's very strange. All of us would expect gold price to go up a lot, but because of hedge fund liquidations, gold price actually took a big dive over the last 10 days. So if you don't have a lot of gold yet, then it may not be too late to still get in, because financial market volatility will remain high for at least the next few weeks.
Can I close then with a last question from Wallace Yu, whom you know very well? He was one of our Asia Global Fellows from 2018. Wallace's question is, how likely would the pandemic lead to new geopolitical tensions as countries become more protectionist, especially, say, between China and the West?
Yeah, it's unfortunate to observe the ratcheted up rhetoric or the ratcheted up war of words at this moment between the US and China, especially with the foreign ministry of China taking the lead to launch this war of words against the US. We should all, especially the policymakers on both sides, should keep in mind words can also have long-lasting impact. We should not assume that words are just words. They don't hurt. Well, once this virus crisis is over, the geopolitical complications will surface more, especially Taiwan in Asia Pacific. Taiwan will be throwing more into the play, and so will Hong Kong if things are not managed properly. I don't think it's in any country's interest to start some World War III.
Thank you, Professor Chen.
Thank you.
It's been an interesting conversation. To our viewers, thank you very much for joining us. Please keep safe. Please keep healthy. Keep that social distance. Thank you very much.